guys. Today we'll be talking about trend lines. This is a very important part of Forex trading, which is the technical analysis, which I explained in the first class and second class in beginning Forex trading and in gambling, and also on my third class about trading sessions. So you need technical analysis for you to be a successful Forex trader. So we move into it. So in the table of contents for today, we're going to go through introduction of trend lines, anatomy of a trend line, types of trend lines, trend line breakouts, support and resistance levels in trend lines, trend line trading strategies, the common mistakes to avoid in trend line and trend line trading, and finally the conclusion. So, what is a trend line? Now, trend line are basically a graphical representation on a price chart connecting consecutive lows in an uptrend or highs in a downtrend. Now pay attention, guys. We are in technical analysis now. And in order for you to be a successful trader, you need the right technical analysis. Now in technical analysis, they serve as a visual tool to confirm and identify the direction of a trend. Now it aids traders to make decisions based on momentum and potential reverse. I'd move into it. So if you look at the two pictures here, you can tell that we are in an uptrend on the left picture and we are in a downtrend on the right picture. So it's very visible to the eyes, and this is exactly what a trend is. Down in every price chart, in every graphical chart, on every currency pair, there is always a trend, and it's advisable for you to locate this trend before you begin to trade. And that is where the bullish and bearish bias come from. So it's a clear representation. That's why I pointed an arrow. You can tell like we're going up and we're going down. And if you're going up, you're buying, you're bullish. And if you're going down, you're bearish. Now, the importance of trends in Forex trading. You get to realize the market's intended direction. Like I said, we are in an uptrend and we're in a downtrend. So you get to know the direction of the market. Now you can see a clear trading opportunity. So once you see you are in an uptrend, you can simply look for buy signals. And if you're in a downtrend, you can look for sell signals because you wouldn't want to be buying something that is crashing. Now, you'll be able to apply risk management settings. Thus, you'll be able to set the right stop loss order to manage risks. Because once you can understand the motion as to which trend moves, you can know when the trend is being exhausted or when it's changing direction. So you know where you can apply your stop loss. And where you're applying your stop loss, it's that the confirmation of your analysis has changed trajectory. Now, you would also be able to see the overall market sentiment, which helps you make more informed decisions in the long-term planning, adjusting your position based on anticipated continuation. So you'd be able to, through the market sentiment, like through seeing the direction of the market, you can be able to anticipate the next continuation, the next one, and the next one, and know where to take another position and take another position. So we're in the anatomy of trend lines. Now the importance of the swing highs and swing lows. When these pivotal points are linked properly, it gives you a clear representation of the market's direction. By connecting the swing highs and swing lows, it provides traders with the actionable insight for making strategic entries and exit decisions in the Forex market. If you had noticed, I showed you on the first slide a trend. I drew the trend. Now you can see a clearer indication of what this trend looks like. And the pivotal points are, once the trend moves from the first point to the other point, it has created a higher high, which is the first higher high. It's the higher high, means it's the highest point of its high. And now this higher high, it goes down and it creates a higher low. It means it's higher than the lowest point at which it created. Then it goes up and creates a new higher high, which is higher than the first higher high. And then it goes down and creates a new higher low, which is higher than the previous low. If you can identify this, you know you are in an uptrend. And if the market goes down and creates a lower low, and then it goes up and creates a higher low, which is higher than the previous low, and then goes down and creates a lower low, which is lower than the previous low, you are in a downtrend. Guys, this is basically what a systematic uptrend and downtrend is. And this is an ideal consolidation or side trend. Depends on what traders do call it. Some advanced traders call it consolidations. Some other traders call it a side trend. An uptrend goes to the up direction, a downtrend goes to the down direction, and a sideways trend has no specific direction. It goes in a sideways manner, and they are mostly in equilibrium. Now, we'll talk about the types of trends. Now, there are 3 types of trend, which I have showed you in the previous slide, and we're going to go into it in this slide. We have uptrend, which is towards the up direction. We have a sideways trend, which is towards the side direction. And we have a downward trend or a downward spiral, which is towards the down directions. Now, trend channels are identified by connecting consecutive highs and low in an ascending or descending trend channel. Now, the graphical connection drawings, it gives traders a clear channel indicating trend's trajectory through the upper and lower boundaries. It acts as a support and resistance, a psychological support and resistance, and it also helps traders to make decisions for potential breakouts or reversal points within an established trends. Now, if you had noticed, the first uptrend I had showed you was a basic uptrend where you have a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and a lower low, a higher high, a lower low, a higher high, a lower low, a higher high, and so on and so forth. And for a sideways, it was to the top, to the bottom, to the top, to the bottom. But this appears to be more complex. Yes, it appears to be more complex because the market is not going to show you an ideal uptrend in this direction, or an ideal sideways trend in this direction, or an ideal downwards trend in this direction. It's going to come in patterns like this. So it's never going to be smooth or never going to be ideal. So for you to become an advanced trader, if you cannot identify the trend, it's best to stay out of it. If you can identify the trend, then you can set up these channels and signals and support and resistance, which we'll talk about, in helping you aid for your entries and exit levels, because you're dealing with real money. So, moving into it. Now, this is an ideal manner as to which the uptrend would look like. It's not necessarily going to look like this, because these particular corrections and impulse movements they occur through rejections of candlesticks, and we'll talk about candlesticks in the candlestick class. But now we're talking about the directions, because this is the very important part for you to make your decision. So if you know you are in an uptrend, right? If you know you are in an uptrend, you'd rather be looking for buy signals than actually looking for sell signals. And if you're in a downtrend, you'll be looking for sell signals than actually looking for a buy signal. Because in an uptrend, it moves faster. The impulse moves are usually faster than the correctional moves. So if you are not an advanced trader and decide to sell in an uptrend, you could lose a lot of money, especially if you have not practiced risk management and stop loss. So it's always ideal to follow the direction of the market, but you would not want to follow the direction of the market at its peak. So you would obviously not buy here when there's a correction for it to go down. You would want to buy at its discount of an uptrend and sell at its premium of a downtrend. So that is exactly where most traders mess it up, or most traders ruin their accounts, because they don't know how to identify a discount and premium in a trend. There is a discount and premium in the trend. It's not about the ideal statement where people say buy the lows, sell the high, it's deep in, buy, it's on its premium, sell. No, like you need to know the low of an uptrend, and that is where you buy, and the high of a downtrend, that is where you sell, because of the impulse movements. And as an advanced trader, you can go for correctional movements. So the market comes in fractals, and it moves towards the reactions of other previous candlesticks, and that's why they tell traders to backtest to see the reactions of what previous prices and actions have done. So this is typically how a sideways trend would look like. So trend line breakouts and recognizing trend line breakouts are quite simple. We have here a breakout signal 1, and we have here a breakout signal 2, and here we have a false breakout. So if you were very attentive to my trend line descriptions, you can see that we have for a downward trend, we have consecutive higher lows and lower lows. And for an upward trend, we have higher lows and higher highs. So for a breakout and a change of trends, you would be looking for a change of pattern. So we have a lower low, a higher low, a lower low, a higher low, where it finds resistance. Resistance is pushing downwards, support is pushing upwards. And then it goes down, creates a lower low where there's a support, and then it pushes up and then finds resistance and it pushes down. And then when it pushes down to its new lower low, it comes up and finds resistance. Now, instead of pushing lower than it should, it finds support on the previous lower low. And when it finds support on the previous lower low, the support is to push upwards. And then it breaks through its initial resistance, canceling one side of the trajectory of a downtrend. So if it breaks through it and finds a support, it automatically becomes a change of trends or a breakout. And this is automatically a change of trends. This is a popularly known chart pattern, which is called an inverse head and shoulders. Usually it has the biggest impulse of reaction of change of trends. And that is very popular, where people say heads and shoulders means it's a sell signal, and an inverse head and shoulders is a buy signal. Now, a breakout signal too. We have a lower low, a higher low, a lower low, a higher low, a lower low, a higher low where it creates resistance, and then goes to a new lower low. And then instead of it to find resistance in the lower low, it breaks through it and comes to the higher low and finds resistance. It doesn't mean obviously it's automatically is a change of trend. That is why it's always good to anticipate than to react, than to predict. So you wait for a confirmation. If it doesn't break this lower low, then you know a change of character is about to happen. Then it comes and finds support. Now you're getting your second confirmation. It broke through this instead of finding resistance, and then it created a resistance here. Now to confirm if it's still a downtrend or a change of character. If it's a downtrend, it has to break through this lower low. If you find support, then you are changing character. Now it's still not enough. And when it comes here, it comes to this lower low and finds a support. But now it did not come to the base, and that is why it's a higher low, because it rejected before it came to the base. So it's a higher low. And then it breaks through the resistance level, creating a higher high, which is higher than the other low, canceling the trajectory of a downtrend, and finds support in a resistance area in the higher low, and then goes above it, breaking the other higher low, creating a new higher high. Automatically is a change of trend, which is popularly known as double bottom. A double bottom is a reverse signal. An inverse head and shoulders or head and shoulders are a reverse signal. Chart patterns, we'll talk about them, more chart patterns and how to find the reversed continuation chart patterns. We'll talk about them in chart patterns class. So this is another breakout signal. And for a false breakout, we have a lower low, a higher low, a lower low, a higher low where it finds resistance, a lower low, and then a higher low. And then it creates this double bottom, which we just talked about. So we can skip through this. It creates a double bottom where it finds resistance at the higher high, at the higher low, and then comes to the higher low, and then breaks through it and creates a higher high. Automatically, you think it's an uptrend. You automatically are looking for, it to come to this path, and that's why we have risk to reward ratio, where I said you shouldn't be so pompous about your targets and find something very conditional. More lucrative traders take profit within the zone. We'll talk about it in the support and resistance class, in support and resistance slide, which is in this class. And then it creates support, and then it rejects the higher low. It comes as a resistance. The support couldn't break this higher low, and then it rejects and creates a new higher low as a support on this higher high, and tries to break it for the second time, and it doesn't work, and then it automatically breaks through the support and it turns resistance. This is a false breakout. It means that the double bottom didn't change the trend. So sometimes it's not every single time that double bottoms comes, or double tops, or head and shoulders, or inverse head and shoulders, or more chart reversal patterns show and they automatically work. These are the reasons. If it's hard for you to identify trend lines, it's hard for you to be able to notice these fake outs and fake breakout patterns. Now we are in support and resistance levels. Now, the point of this class is to make things as simple as possible. So how can I make it as simple as possible? Now you need to understand the relationship between trend lines and support and resistance. And what I was explaining to you in the last class was when the price goes down, it comes down to a lower low. Now this lower low creates a support. Now this support pushes the market back. That is why the price actually do go back. And now this reverse pattern you're seeing here is called a correction pattern. They are usually slower than the impulse movements, which is the longer ones. The longer ones are faster, the shorter ones are slower. So it's called a correction because the market can't just go up and down. It has to go in a diagonal manner, in a trajectory manner. So when the market has this impulse movement, it makes a correction for that gap. So once the market goes down and then goes up, it creates a resistance level in this higher high. Now, a resistance, like I said, is pushing downwards, right? A resistance, like I said, is pushing downwards. So let's take it as a floor level. So we have floor 1, we have floor 1, we have floor 2, we have floor 3, we have floor 4. If you are on this floor, I don't believe you can go over a ceiling, right? You cannot go over a ceiling. So it means you have a limitation. So once it comes here, there's a limitation. Now the limitation can only push you downwards. So this is the higher low. It pushes you downwards to the lower low. And then it comes to a support, means you're on another floor. Now you are on the ground, you are on the slab, and this is a ceiling. This is a slab, and this is a ceiling. So the slab automatically becomes a ceiling depending on the floor you are in. If it creates a higher high and then comes down and creates a lower low, here automatically becomes a support. And when it goes up, the previous floor where you were in this floor, which was a support, becomes a resistance. It becomes a ceiling. If you are someone who lives in a multiple story buildings, you can understand that if you look on top of your house, on top of your living room, there's a ceiling. If you go to your bedroom, it's a floor. That is exactly what support and resistance is. And then it creates a higher low, and then it goes down, and then it creates a subtle support. This is not a strong support. It creates a subtle support. The stronger the support and resistance, it means that it has tested that area multiple times, and that is why the support is stronger. So areas at which the lines have tested multiple times and held and made an effect are the strongest supports. Where it has touched minor times are the weakest support or resistance. And that's why you can see a lighter green markings and a thicker green markings, because it has tested multiple times. And then if it tests multiple times, or it has a big push, bigger than it should, that is a strong support. If it has a big push towards the down direction, that is a strong resistance. If it has tested multiple times, that is a strong resistance or support. That is how you can identify a proper support and resistance. And if you're looking at the support and resistance trading from this same trend lines from the head and shoulders, you can tell that after it has made its movement here, it found a very strong support on this level. It rejected it before it even came to the support due to how strong the area is. It came, and this other support, which it turned to resistance, pushed the price back. And then it came and met on this strong support that pushed the price backwards in a big impulsive manner to the ceiling. And the ceiling pushed it but wasn't strong enough. And then it created another support where it had rejected in this area. So it came and created another support. And then it's like climbing a staircase. If you climb a staircase, you break through the floor, which automatically becomes a ceiling, and then you land on the floor and you are in another floor. So it then changes direction and then finds its support and breaks through, and automatically this resistance here becomes a support because you broke through. So you climb another staircase and get on the next floor. So this is exactly what resistance and support is. I've made it in a simple term, and in the simplest term, this is how you can identify a support and resistance, and identify a key support and key resistance. Now, trend trading strategies. How can you follow a trend line? Now, counter trend is trading is finding a buy signal in a downtrend and looking for a sell signal in a buy trend. These are more used. These are more used. Like, these are more typical from advanced traders. These are more typical from advanced traders. They decide to trade the correctional movements. So they come and get a buy in this support and sell once it comes to this resistance, this resistance and this resistance level. And they take another buy here and then they sell here. So this is exactly what a counter trend strategy is, and trading with trend lines. Now, if people who trade on trend lines wait for a rejection, why people draw a trend line on a trend? Now, a trend line it's a diagonal support and resistance level to help them know where to take an entry. So just like where you buy here and sell here, traders wait for this trend line and sell here so they can get the right action of the impulse movement, wait for the next resistance and sell here, wait for the next resistance and sell here. Same thing as the uptrend, wait for the next support and buy here, wait for the next support and buy here. It's as simple as that. Now, common mistakes to avoid. Now, what are the mistakes to avoid? Do not overtrade. Please do not overtrade. Do not ignore risk management. It is very important you pay attention to risk management at every condition. No matter how confident you are, no matter how you've identified the direction of the trend and it's been going your way, always apply risk management due to fundamental analysis. Most markets, the bigger players in the market can push the market more than it should, and it automatically changes the overall sentiment of the market and direction, which we traders we have to readjust to. And that is why a stop loss is necessary in risk management. And it's always good to adapt to the changing markets. So once these big players change it, you need to be able to re-strategize. It's very important, and it's one of the mistakes most traders do avoid. And they always have pitfalls in the trend analysis. They always want to imagine the trend goes a certain direction because they've found an ideal direction of what the trend is. You don't say, because it's a downtrend, I'll keep selling at this point. You have to wait for a confirmation. And the confirmation is looking for the most likely support and resistance in those zones. So you have a diagonal resistance, a diagonal support, a vertical, and a vertical support and resistance to be able to give you the right entry you need for a buy or a sell signal. Thank you, and see you in the next class.